Okay, thank you everyone for joining. My name is Hudson Gilmer and I head up the commercial markets team here at Genscape. It's great to see so many clients joining the call as well as familiar names. I just want to give a brief introduction and then we'll hand it over to our speakers today. We won't talk about who Genscape is. I think most of you are aware of that. But our core mission, as most of you know, is bringing transparency to commodity markets. And for those of you familiar with the Mexico market, one of the first questions we always get is, how do I get good access to data, transparent data on the markets? And it's really, there's no market that needs transparency more than Mexico. We've been involved there for about the past year at the request of our clients, and our goal is really to roll out a lot of the same fundamental data services as well as forecasting services for the Mexico market as we offer in the U.S. market and other geographies. Mexico, for those of you who have been watching it, is a really exciting story. It's not often that you get to witness the transformation from a state-controlled monopoly to a fully functioning market in such a short time. Now, granted, there's still a lot of work to do to get the full participation in the market, but overall, I'd say we've been really impressed with the speed and professionalism of the reforms that we've seen both on the power and on the gas side. And we're honored and excited to be playing a small role in supporting this market. So I'd like to introduce our speakers. First is Sam Johnson. Sam is our senior power analyst for Mexico, and he's going to start with a brief overview of the structure and status of the Mexico power market, and then introduce Genscape's EPSI Mexico modeling platform. We also have Rick Margolin, who is the senior natural gas analyst. He'll walk through the fundamentals of supply and demand that we're seeing in Mexico and also share data, proprietary data that Genscape is collecting on flows of U.S. exports of natural gas to Mexico, as well as what we're forecasting going forward. Just a few housekeeping items. We did see a few questions come in about a dial-in number. There is no dial-in for this webinar, so you'll actually need to use the computer audio in order to listen. Secondly, if you do have questions, you should see a question box on the bottom of your screen. Feel free to enter those, and we'll try to cover as many as possible at the end of the session. And finally, we'll send slides to everyone who participated in the webinar tomorrow, and we'll include contact details on those. So I think I covered the agenda at a high level. Sam's going to start us off with an overview of the structure of the market, the state of the market, some of the early results we've seen, and then introduce EPSI. Rick will then take us into the natural gas market, the supply and demand fundamentals, and some of the proprietary data that we've been collecting, and then we'll circle back with Q&A. And one note, we will have a couple of poll questions during the webinar, so we want to get your feedback and also make sure you're still awake, so be prepared for those. Take it away, Sam.
Great. Thank you, Hudson. I wanted to start with a really quick intro on the market for anyone who's not familiar with it. This is not at all an exhaustive summary of the reform, but really just some of the highlights of the structure of the market, as well as the state of the market and the progress that has been made so far. So up until this point, the state-controlled CFE utility has had a monopoly on power generation and distribution. And CFE is being broken up into 7 autonomous companies that will operate independently and participate in the now open market. The markets are being defined by the Ministry of Energy, CENER, which is effectively equivalent to FERC in the U.S., and they have established an ISO similar to a PJM or a MISO, and that ISO is SENACE. So the markets have been very much structured after a PJM or a MISO. They include spot markets, ancillary markets, capacity auctions, FTR auctions, and clean energy certificates. Geographically, the market is broken up into 9 separate demand zones that can further be subdivided into 52 transmission zones. 7 of these zones are together in the interconnected system, and then the last 2 are in Baja California and are not connected to the rest of the demand zones, though they are connected to Southern California. The progress that has been made so far in Mexico, the day-ahead market has been live since January, and the real-time market, CENER is targeting to have it live by the end of the year or in early 2017, and they are really pushing for increased participation in the market. It's still very much dominated by CFE, but we've started to see some other investment. 2 new gas-fired power plants were recently constructed by 2 private companies. And CFE is still very much in the process of being divided into these 7 autonomous companies. The goal is for them to be completely independent by January. Some of the intermediary steps include the naming of boards and CEOs, the division of generation, and also the division of employees. One milestone that CENER and SNACE did accomplish, they held the first auction for clean energy certificates a couple of months ago, and this was widely considered to be a successful auction. They awarded 18 certificates to 11 companies to build a little more than 2 gigawatts of solar and wind. About 75% of these certificates went to solar projects, and this was actually pretty surprising. Most people who are down in Mexico and tuned into the market were expecting about 2/3 of them to go to wind projects, and solar ended up taking the bulk of them. So our first poll question, in the spirit of CENER wanting to increase participation in the Mexico market, of those of you who are looking at Mexico, when do you intend to register as a participant in SNACE, if you do at all? And feel free to click any one of the 5 options, and we'll give you 30 seconds and then see the result. So half of the respondents are never going to join in with the Mexican market, and that result is not too surprising to me. This is a very diverse crowd of participants in this webinar. I think a lot of people on the call are comfortable keeping their business in the United States, but the rest of the results, those who sort of are looking at participating in the market going forward, it is interesting to me to see that most of you, about half of you, are waiting until next year. And this is something that we've picked up on talking to a lot of people who are interested in becoming a participant in the Mexican markets. There's still a lot of trepidation out there, and a lot of people expect this process of deregulation to move very, very slowly. So it may be a year until there is liquid trading going on and the opportunities that some Genscape clients are looking for. So sticking with some of the state of the market, These are the initial spot results, and keep in mind that this is only day-ahead pricing, but this is a look at where prices were coming in from February 1st through May 30th. In the interconnect, which is labeled as SEN on this map, prices are about $45, so quite a bit higher than the neighboring ERCOT. And the most expensive prices of all are down in Baja California, where they're almost $75. And that's a result of Baja Sur really being cut off from the rest of the interconnect and not having a lot of cheap generation. And we'll touch on that a couple more times in the presentation. One thing that Senair has done is they have published a pretty detailed outlook for their expectations for the development of the national electric system from now through 2030. And it contains pretty detailed information on demand growth, transmission network upgrades, generation additions and retirements, and fuel prices. Some of the specifics contained in this document, they're expecting demand to grow by about 3.5% per year. Their outlook is very detailed, and it's broken out into the zonal level. So there is some variance from zone to zone, but at the national level, they're expecting 3.5% demand growth. This document details the $132 billion of investment that they're planning on for the transmission network in the next 15 years. And they're also targeting a very aggressive 35% renewable fuel mix by 2025. They're at about 16 or 17% right now, and prevailing sentiment is this is a very aggressive target and may be overly optimistic, and they may have a hard time meeting it. Lastly, I just wanted to touch on the Genscape Power Services that are available in the US markets in the context of Mexico. So our Power RT platform that monitors real-time output from generators around the country, we are planning to bring this to Mexico as well. So you will be able to view the status of power plants and get alerts about them within the Mexican territory. The Power IQ service for demand forecasting, price sensitivities, congestion analysis. We are working on developing all of these services for the Mexican market. Currently, our 14-day demand forecast on a zonal level and our Valday next day demand forecast is live. And the last product, and the one we really want to focus on, is EPSI, which is a long-term modeling platform that is actually live in Mexico, and we've been able to do a lot of price modeling in Mexico with this platform. So, like I said, EPSI is a long-term modeling platform that will model energy prices, fuel mix, renewables output, basically anything that you could want to model within the energy market. It can run anywhere from a month to a 30-year scenario or outlook. And it really solves a lot of the issues that exist with current modeling options for this scale of modeling. Right now, people have three main options when it comes to long-term modeling. One is to license a large and complicated model that requires a significant amount of time to learn and to run. Two is to build your own ad hoc model. And we all love our spreadsheets, but they can be hard to maintain and hard to share with others. And the third option is outsourcing to a consulting group, but that is expensive and you often have very little flexibility in terms of actually picking the inputs on your own and can often not really see what's going on behind the curtain. And all of these options require pretty extensive data research, collection, management, that can require a lot of time and occasionally a lot of money. So FC really serves to solve most of the problems encountered in these traditional modeling solutions. So it allows you to run powerful scenarios out to 30 years very quickly and with very little training. It relies on data from two primary sources, and this really gets to my point about the time that can be consumed in data collection and data management. So we've done extensive research in fundamental data, things like detailed plant information, what technologies are they running, what fuels are they burning, what does historical demand look like. This is all data that is incorporated into the model. The second source of data, you have the ability to put custom data sets into any of your scenario runs. These come from both third-party vendors, as well as if you want to build your own data sets, they're very easy to incorporate into the FC model. And all of the scenario results can be displayed and shared in a very easy-to-use dashboarding system. Some of the really key benefits of the FC model, one, it's ready to go as soon as it's in your hands. There's no installation. It's fully hosted by Genscape and accessed via a web browser. It's extremely easy to use. It does not require extensive training of an analyst team or even a single analyst whose full-time job it is to do long-term model runs. It's really easy to pick up, and it's also very, very fast. While some long-term models can take hours to do a single model run, you can kick off a couple of FC model runs in the morning while you're getting a cup of coffee. And that's one thing that the users of FC really appreciate. They can bring it into a business meeting and say, okay, well, what if we try this scenario while we sit here, and they can run it, and it'll be done in usually 3 to 5 minutes for a standard model run. I talked a little bit about the data. It's very high quality. We've done extensive research. All of it is cross-checked, and it's fully sourced. So if you want to say, where did Genscape, where did FC find this piece of information? We have our sources documented, so you can go and check them. And then lastly, we have a very strong support system on the FC team. People both with experience running and developing the model, as well as experience in the Mexico market. So turning to what FC actually looks like, this is the landing screen of the FC platform, and it's incredibly easy to navigate. I've already touched on a number of the features, so I won't go into detail too much, but the system data allows you to see all of the model inputs. That's where you find the information on the plants that are built into the system, their technologies, the historical demand data. And like I said, it's all very transparent. In addition to sourcing all of the information, we also have these two panels that provide recent updates. So anytime we make a change, whether it's adding a plant, retiring a plant, changing the fuel that a particular plant burns, you see that right away. The market data is where you can input your own custom data sets or purchase data sets from third-party vendors like Genscape or ICE or pattern recognition technologies. And then the analysis and the dashboard are really the meat of the product and can really demonstrate what the scenarios that FC produces looks like. And so we wanted to give you a couple of examples on the analysis module and the dashboard. This is a pretty basic dashboard that we developed. What we did is we took the assumptions of the ProtoSen. For anybody who was asleep during slide number 7, the ProtoSen is Senair's 15-year outlook of what the market is going to look like, demand assumptions, fuel assumptions, etc. So we took those assumptions as gospel. It doesn't mean we agree with all of them, but we wanted to see what an FC model run would look like if we input all of that data as is. So you can see a number of things in this dashboard. What does demand growth look like over the next 15 years? How does the complexion of the supply stack change? And what you can do is we have now incorporated this data set into the FC model, and any FC Mexico users can take this data and use it as a jumping off point or a base case. So if you wanted to take the ProtoSen and say, I don't agree with Senair's target for renewables in 2025. I don't think they're going to get to 35%. I think they're only going to get to 20%. You can very easily go and adjust their wind generation assumption over the next 10 years and bring it down and see how that changes these results. And the beauty of the platform is that because these model runs go so quickly, you can do a number of permutations all at once. So if you want to see what the results look like under 1% demand growth and 3% demand growth and 5% demand growth, it's very easy to run all of those scenarios at once and have different results all within about 10 or 15 minutes. And then the dashboarding, this is an example of what a dashboard might look like. Very easy to put together, very easy to build, and very easy to share. Even if somebody in your company doesn't have a license to EPSI, they can still see the dashboarding results. The other example that we wanted to share with you is a sort of comparative analysis that you can do using EPSI. So I wanted to see what would happen over the next 15 years to Baja Sur prices. Again, that's the point of the interconnect of the system where prices are very expensive right now. So what would happen over the next 15 years if Baja was interconnected with the rest of the system versus what would happen if it was not? So the model run on the left assumes that it is not connected at any point to the interconnect. And all other assumptions, we just kept the ProtoSen assumptions in there for demand growth and fuel prices. In the model run on the right, that's what happens to prices if Baja Sur is in fact interconnected with the rest of the system, as Senair is planning on doing. And you can see in both cases, there's a steep drop off in prices early as they build a new plant in Baja in 2019, which is their plan. But then prices continue to climb over the next 12 years in the scenario on the left. So that's just one or two examples of the type of analysis that you can do with the EPSI platform, but it's completely customizable and completely easy to use. So whatever you want to do with it, you can. Just in summary on EPSI, the platform has been active in European markets for about 7 years now. It's been very well received and was even given an Energy Risk Award in 2014. We are developing it, and we are going to be bringing it to the United States hopefully in the next year. So those of you that use it in Mexico will be familiar with it as we move into the US markets. It's fully hosted, it's easy to use, it's really fast. We keep the data really up to date and are very transparent with it, and the support team is large and it's growing. We have analysts in Zurich, Amsterdam, Boston, and hopefully in the near future elsewhere in the United States. So that is my summary of the power markets and EPSI. I will pass it off to Rick Margolin to talk about natural gas.
Great. Thanks, Sam and Hudson, and thanks everybody for joining us today. As Sam sort of alluded to, there's just a ton that's happening within the Mexican market as a result of the 2013 energy reforms, and so trying to smash that all into an hour is a little tricky. So I apologize if this goes pretty high level, but certainly feel free to submit questions to us afterwards, and hopefully we address a lot of your interests through this right now. Now, for a lot of the reasons that Sam talked about with regards to the market reforms, there's a lot that's changing within Mexico's power market. There's also a lot that's changing within Mexico's industrial market as well, and those two things together are increasing Mexican demand for U.S.-sourced natural gas. And from our clients' perspective and market participants' perspective, Mexico is of great interest really for two reasons. One, understanding how much the U.S. is exporting to Mexico is very important to people's daily supply and demand balances for the lower 48 U.S., for those that are balancing Texas, obviously this has a great imperative. For those that are watching the Southern California market, wondering if Mexican growth could siphon off supply to California. All of these are points of interest for participants within the U.S. market. So as Sam's poll question showed, about half of the folks here on today's call don't intend to actually participate directly within the Mexican market, but that still doesn't change the fact that Mexico is very influential on U.S. supply and demand dynamics. The other source of interest with regards to Mexico are from participants who are seeking to actively participate within Mexico. So having a good understanding of where gas is coming from, how it's getting into the market, how it's moving throughout the market has taken on increasing importance. And what we've seen over the last several years is that exports have been growing. And I want to talk about today a couple of different reasons why that's happening. The first one I want to talk about is on the demand side within Mexico. There's a lot of demand growth for natural gas that's being fueled by the power market as well as Mexican industrial sectors. So I want to talk about what's driving those two factors. And then I want to flip it over to the supply side within Mexico, because at the exact same time that Mexican gas demand has been growing, Mexican domestic gas production has been in decline. So we want to talk about some of the reasons why that's been happening, because that's going to be very influential on our understanding or expectations for future production volumes within Mexico. And we'll show you what some of our expectations on both of those fronts look like. In addition to the supply and demand fundamentals, Mexico has also been drawing greater volumes of U.S. gas for two additional reasons. One is to enhance reliability of service within the Mexican market, and number two is to gain access to better priced sources of supply. The market reforms have basically enabled Mexican consumers to sort of diversify their source of supply to enhance reliability as well as pricing. As this has occurred, it's become more gas flowing across the border. At the same time, a lot of these increased volumes have been moving on pipelines that don't report data on a very timely basis. And that problem is only going to get worse as we move into the future with pipeline expansions. So Genscape has sought to fill a market need by using our monitoring technologies and know-how to give market participants what we hope and believe is the most timely and accurate estimates on a daily basis of exports from the United States into Mexico, and hopefully soon within the Mexican market as well. So at the very end of this, I want to bring this all together and show you what our expectations are for U.S. exports into Mexico going forward. So to get to that, let's go ahead and talk about intra-Mexico supply and demand fundamentals. And let's start on the demand side. And as Sam mentioned, the power market is reforming, and Protocen and SENER, the Mexican government agencies, are forecasting future load growth. Presently, about a little under 50% of Mexico's installed generation capacity is natural gas fired. However, roughly 60% of actual generation comes from natural gas, and that is a number that has been growing over time. Mexico certainly does have a diversified power generation portfolio. It has natural gas, it has fuel oil-fired generation facilities, renewables are growing. It has about 10% of the stack comes from hydroelectricity. There's a nuclear plant, etc. But looking forward, the large areas of generation capacity addition are going to come from gas-fired facilities and renewables. This is happening for a couple of reasons. Again, it's to diversify the market, it's to create some transparency and better market behavior, but it's also to serve expected load growth. As you can see in the chart on the lower right-hand corner, loads have been growing in recent years, and Protocen, as Sam mentioned, continues to expect growth to occur roughly about 3% or so per year between now and 2020, and actually beyond. A lot of that growth is coming from Mexico's industrial sector. As you can see in the chart in the upper right, the industrial sector accounts for nearly 60% of the consumption of Mexican generated power. And Mexico's industrial sector, for reasons I'll talk about here momentarily, is one of the bright spots in the global economy right now. So the loads are growing because of industrial. You've got more cooling loads growing with population growth and migrations to population centers and folks tying into the grid, etc. So moving forward, the expectation is for load and demand to grow for power generation. On this chart here, you can see a couple of different forecasts, and really, I've broken this out really just down into two sectors. This is showing natural gas demand by sector. I'm only showing industrial and power because ResCom demand for gas accounts for less than 0.1 BCF per day per year, so it's a fairly negligible volume. The main load is for industrial applications as well as power generation for cooling applications. The forecasts in the stacked shaded areas are provided by SENER, and the dotted red line is where Genscape expects the growth to occur. As we talked about, power is expected to grow, and in this case, we're basically relying upon SENER and Protocen's forecasts, with a few exceptions. In general, we think that the SENER forecasts are a little overly optimistic on both supply and demand issues. I'll talk about what's happening on the supply side here momentarily, but we do think that they tend to be probably overestimating future projections for gas demand here in the future, but not by much. In fact, when you get to Genscape's dotted red line forecast, the reason it's lower is primarily because of our expectations for industrial growth. We're a little less bullish on industrial growth, primarily because of our expectations for Mexican gas and oil production. And the reason why we pull that down out of our demand forecast is because Mexico's refining and oil industry accounts for about 60–65% of what constitutes quote-unquote industrial gas demand. For reasons I'll talk about in a moment, we're not as bullish on the growth of Mexican production. Therefore, we're not as bullish on our expectations for the refining and oil industry's growth in gas consumption. But separating refining and oil from the rest of the industrial sector, we actually are very bullish on industrial demand growth within Mexico. It seems like not a day goes by where we're not reading an announcement from a major multinational firm saying, hey, we're picking up operations and we're moving them. So Ford announced earlier this year that they're taking operations from a manufacturing facility in Canada and moving it to Mexico. Carrier Air Conditioning is moving their manufacturing operations from Indiana to Mexico. Sharp, Samsung, and Sony are moving. Major auto manufacturers like Kia, Volkswagen, BMW, Audi, I mentioned Ford, GM, etc. They're all opening up new operations down there. And when they talk about why they're relocating, there's very common threads amongst everything that they're saying. They're talking about the proximity of manufacturing to the U.S. demand markets, not just geographic, but the benefit of having free trade agreements with the U.S. They talk about a relatively stable political economy and a well-educated but relatively affordable workforce. But one common thread that always seems to stick out is their notations that the infrastructure on the energy side getting built out is sort of the last chip that these folks needed in order to feel comfortable moving their operations from overseas into Mexico. So when we talk about infrastructure development, it is a little bit of the mantra, if you build it, they will come. Now, there are going to be questions about how much of the capacity on the pipelines and the transmission lines and the power plants will actually get used. We at Genscape are not expecting full utilization of these new projects, but in part, we do subscribe to the belief that if you build it, they will come, because we're seeing direct evidence from manufacturers, major global industrial consumers, saying now that they have adequate, reliable, accessible supply, they're comfortable moving their operations there. So as we look into the future here, on the demand side, we do see growth. And one other point that I want to note out here is a lot of this growth, too, is occurring because of both just enhanced reliability as well as the market reforms that are giving consumers access to U.S.-sourced gas, which is a lower-cost source of supply. So flipping it over to the supply side, another reason why Mexico is using more U.S. gas to meet its demand is because its own domestic production has been in pretty sharp decline. As you can see in the left, raw gas production volumes have taken a fairly sharp downturn in the last, say, year and a half or so. In fact, in Pemex's latest production report for April of 2016, they reported that gas production had reached its lowest levels since roughly late 2007. So there's been a pretty dramatic drop-off. Now, some of that is because of maintenance issues, et cetera, but nonetheless, the trend is pointing sharply downward. The fact of the matter is that production is, by all intents and purposes, wholly controlled by the state-owned Pemex. Pemex is carrying a very severe debt obligation. They're also carrying that debt obligation at a time when their infrastructure is aging, it's inadequate. This is kind of the stuff that we hear from industrials in Mexico when they complain about lack of reliability or lack of reliable service. It's one impetus behind their desire to connect to a different type of gas and power grid, and even one that connects into the U.S. Now, on the dry gas side, you can look at the historic dry gas volumes in the chart on the right in the solid green area. And then to the right of that, you're going to see two different forecasts. The top forecast comes from CENER, and the bottom forecast comes from the U.S. Energy Information Administration's Global Energy Outlook. There is a very wide divergence in those forecasts. CENER is expecting growth to resume fairly soon. EIA expects growth to resume, but not for several years. At Genscape, we tend to hew a little more closely towards the EIA forecast. And the reason is not just because of Pemex's debt obligations and the state of Pemex, but the fact of the matter is that while the market is reforming, while Mexico is actively trying to attract foreign direct investment and joint ventures with foreign companies, and even open up the market to Mexican E&Ps, the reality is we believe that the ability of these reforms is probably going to take a while. Mexico's had a series of auctions to basically divest assets, and some of those auctions have performed well, but some have not. And there's questions about, the companies that have won some of the assets, the production assets, about how quickly they can bring production online, et cetera. So when looking at the future for Mexican supply, at Genscape we tend to be a little more bearish with regards to the restoration of growth in the near term. So those two factors, increasing demand at a time of decreasing production, along with the desire to enhance reliability, along with the desire and ability to gain access to different supplies that are, ostensibly better priced, is really what has been driving the growth in U.S. exports from natural gas, or from the U.S. into Mexico. And you can see here in January of 2015, over on the far right, that growth rate really took a big spike, and that was because of a new pipeline that came into the market. That's the Net Mexico pipeline, which flows gas out of Texas's Agua Dulce hub down into Nuevo León and Tamaulipas, Mexico. When that pipeline came on, it wasn't necessarily serving a whole lot of new demand, but really the reason why exports spiked is a demonstration of the fact that this gained Mexican consumers access to new, diverse, better priced sources of supply. Now, going forward, this is going to be very interesting to watch, and it's going to be very difficult to keep track of. And the reason for this is because as exports have grown, more and more volumes have been moving off, or have been moving into Mexico via intra-state systems. These intra-state systems are not subject to the same daily reporting requirements that interstate pipelines are. And so you can see over in the left where, whereas at one point back in 2010, 2011, you could use interstate pipeline nomination data to estimate roughly 80% of what was actually leaving the United States into Mexico. But today, because more gas is moving on those intrastates, your interstate sample is accounting for less than 60% of what's actually flowing. In addition to that, we can see that there's a lot of interconnectivity of pipelines, so that relying simply on interstate nomination data by itself is becoming an increasingly challenging proposition. A big reason for this is that one pipeline alone, the Net Mexico pipeline that connects into Mexico's Los Ramones system. This one pipeline by itself accounts for over 30% of total U.S. exports to Mexico. So at Genscape, what we did was we used our proprietary monitoring technology and modeling efforts to go down and monitor flows on this and other intrastate systems. In the case of Net Mexico, what we're doing is we are using electromagnetic frequencies to measure power consumption at compressor stations, which thankfully correlate very well to daily gas flows. So we are able to provide an estimate of daily gas flows on the Net Mexico system to our clients. When we do this, not only are we able to give you a good estimate of what's flowing on this one pipeline, but when we combine those estimates with the other interstate data nominations, we're getting effectively a larger sample than you would get by just relying on interstate data by itself. When we have an enhanced sample, that reduces the volume of error that we get when we're modeling total daily exports to Mexico. So what you can see in the two charts on the right, those are our estimates for daily exports to Mexico. If you don't have a daily estimate, basically you have to wait 3 months for the EIA to come out and tell you what flowed 3 months ago. So what we're trying to do is give you the ability to get a real-time daily estimate of what's been flowing. And when we're doing this, our objective is to make sure that our absolute error relative to what the EIA ultimately reports is less than 5% of what the EIA reports. And so far, we've been doing this for about 13 months, and I'm happy to say that our average absolute error in that time has been 3%. We hope and believe that using this proprietary data coupled with our sample data can get you to what we believe is the most accurate daily estimate of U.S. exports to Mexico. The other thing that we're doing is obviously we're messing with data, we're looking at data, we're monitoring stuff, but at the end of the day, it's we can sit in our offices in Houston or Denver or where have you and look at data, but there's really nothing to be said for, or so much to be said rather, for getting boots on the ground. So 2 weeks ago, I went down and I looked at a variety of pipelines, industrial facilities, power generation facilities. We were able to alert our clients as to the construction status of some of these major demand facilities, major pipeline facilities, and give market alerts to our clients on a timely basis regarding the status and estimated in-service times for these projects. So basically what we're doing is we're supplementing monitored data with boots on the ground and talking to folks who are either developing these projects or hold capacity on these projects. And like I said, all of this is going to take on heightened importance going forward. As I showed you, the expectation is for Mexican gas demand to grow. The expectation is for Mexican domestic production to decline. That coupled with the need for enhanced reliability, access to better priced sources, and I should also note the desire amongst the Mexican government to displace LNG imports. All of that is leading to an increased reliance on imports from the United States. And over time, over the next 5 years, we're going to see some pretty massive pipeline projects get built to move increasing volumes of gas to the border. In fact, between now and 2020, there's over 6.7 BCF per day of new pipeline capacity that's either under construction or proposed for development to move gas out of the U.S. into Mexico. Again, I want to emphasize that just because all this capacity gets built doesn't necessarily mean that it's going to get utilized. However, for all the reasons we've been talking about throughout this presentation today, we do believe that utilization rates will look rather impressive to support the trend in growing U.S. exports to Mexico. So what is our expectation? Well, basically between now and 2020, we at Genscape expect that exports will continue growing. We do expect that you'll see some sort of step changes upwards when you get certain pipelines within running to the border as well as within Mexico coming online. Right now, the big project that everybody's kind of waiting for to come online is Los Ramones 2. We've issued a client note that the north portion of that is actually running, but it's running with gas that's been basically shuffled around. The big project's going to be Los Ramones 2 South, or SUR, where we expect a bump in U.S. exports of about 0.3 BCF per day or so. And then you can see in the chart that there's a bunch of other U.S. and Mexican pipeline projects coming online that will facilitate increased exports because of rising demand, because of supply diversity, because of prices, etc. So we'll take a break here for a second to issue a poll question. In that previous chart, we have exports getting pretty close to 5.4 BCF per day by mid to late 2020. And so the question is, do you think that that estimate is too high, about right, or too low? So we'll give folks a couple seconds here to go ahead and submit that, and then we'll move on. All right, so assuming everybody has moved on, let's see here. All right, so it looks like a little over half of you think that that estimate's about right. About a quarter of you think it's too high, and about 20% with too low. And it's really interesting to see that kind of response because you will see, as I showed you earlier, the Mexican government has one type of forecast. We see bank forecasts come in higher than us. We see other agency forecasts come in lower than us. It sort of exemplifies the I guess just the uncertainty about the future development of the market. There's certainly risks. Obviously, production can come in higher than we are expecting. The ability to attract foreign direct investment could be wildly successful. On the power side, power could come in lower. Power demand for natural gas could come in lower than we're expecting as renewables meet their targets like Sam was talking about. lots of ambiguity about what this market looks like going forward. But in general, most expectations are for U.S. exports to continue to grow to meet that growing demand and supply diversity needs. So if tracking this is something that's of importance to you and your company, would definitely recommend you check out the power products that Sam showed, as well as some of our gas products. On the gas side, we have a couple different offerings under our Mexico Natural Gas Product Suite. Every Friday, we publish a weekly U.S. natural gas exports to Mexico report that provides a summary of our monitored proprietary data, the public data, kind of recaps what happened in the week prior, as well as lists our analysis of major market events that will impact the market moving forward. If you have the need for raw data, whether it's sample or Genscape proprietary or monitored, all of this Mexican data can be queried in our Genscape Analyst platform that will enable you to slice and dice the data in really, hopefully, any format that you want. And then lastly, I want to note that our clients of our Mexican gas product suite get access to our Mexico knowledge base. Basically what this is an in-house database where we're archiving essentially every bit of information we collect on the Mexican market, things like pipeline development, transmission, power plants, who holds the contracted capacity, what tariff rates are, etc. We also issue market alerts to our Mexico clients when they come up and are applicable. So would definitely encourage you to check out our Mexico gas product suite. So in summary, basically, we expect U.S. exports to Mexico to continue growing to meet that growing Mexican demand at the same time that Mexican domestic production is in decline. There's also the imperative to enhance reliability of gas service to Mexican customers who also want access to lower cost supply than they can get from either domestically produced gas or from what is available via the LNG import market. So all of those are reasons why we are looking at exports increasing, in addition to the fact that pipe capacity to the border as well as within Mexico is building out at a pace that would be commensurate enough to satisfy these trends. So estimating that, however, is going to become increasingly challenging as more volumes move on to non-reporting pipelines. So if that's something that's of importance to you to track on a daily basis, please don't hesitate to reach out to us. So with that, let me turn it back over to Hudson.
Thanks, Rick. So we've got a lot of great questions. We'll get to those in just a minute, but I did want to share one more thing before we do that, and that is that if you remember when Sam was talking about the PRODECEN, the 15-year study that was issued by Mexico's Ministry of Energy, we have that data. That's a great set of data. But what's important to remember about that is it reflects the party view of the ministry and is perhaps not consistent with reality on several fronts. For example, it assumes that 6 new nuclear units will be built over that time period. It assumes that Mexico will be successful in reaching that 35% renewables target. It assumes that all the recent auction winners of renewables, all those projects will actually get built. And so we've had a number of clients who have come to us and said, is there a reference case available? Is there a study that can actually give me a set of assumptions that are more grounded in greater reality of what will happen, or offer a set of scenarios that are more balanced? So what we've done is partnered with Energy Narrative, which is a very well-respected group headed by Jed Bailey with over 20 years of experience in the Mexico market, to develop a multi-client study of the Mexican power market through 2035. So this multi-client study will basically consist of a kickoff workshop in September, where those who participate will be able to influence the selection of the scenarios that we run through that. both Genscape experts as well as energy narrative experts will develop those scenarios over the next couple months, developing independent assumptions, documenting them all, modeling the results, and using the EPSI platform to do that. And then we'll hold a final workshop in December where we share the results and the storylines. And the nice thing about that timing is we'll also be able to incorporate the second auction results, which can significantly influence the market. So just wanted to share that. Anyone who does sign up for this will be able to participate in those workshops and obviously would get access to the final reports, the presentations, the data sets, and they'll also be embedded within the EPSI platform, so you'll be able to run sensitivities on those different scenarios that are built in the multi-client study. So please contact me, contact Jed, or contact your Genscape sales director if you do have interest in getting more information or seeing a prospectus on that. And with that, let's move to questions. We got a lot of them, and maybe I'll start with one for Sam, and that is EPSI solving at the nodal or the zonal level?
So the short answer, for the sake of time, is that it is solving at the zonal level. The 9 distinct demand zones that I highlighted a couple of times throughout the presentation, it's solving prices specifically for those zones. And the reason for that, the main reason why it's not a nodal model, is that nodal modeling is kind of a crapshoot. We have a tough time with it. Everybody has a tough time with it on a Val day and a next day standpoint, let alone looking out 20 years. So we really don't think that the models that allow you to do nodal modeling over the course of that much time are really that accurate. So we'd rather produce something where we feel good about the results. And then if anybody has follow-up questions about specifics of the transmission grid, we do have additional information about that that's not incorporated into the model itself, but we can answer questions about it.
Okay. So next question to Rick, is the industrial demand growth regionally concentrated? And if so, what specific regions?
Yeah, the industrial demand growth is, I mean, yes, it's concentrated. I don't want to imply that it's not occurring throughout the country, but for the most part, the growth is concentrated in the northern states, primarily those that border Texas, so Tamaulipas and Nuevo León. And in fact, you see most of the pipeline projects are really targeting those regions around the city of Monterey. The pictures that I showed from our site visits, those are from the city of Pesqueria, which is just east of Monterey. Everything in between those two cities is under development. So that's the bulk of where the industrial development is occurring, but there's also some very major projects south of there in San Luis Potosí, which is just east of the state of Mexico, or District Federal, and then farther south there's some big auto manufacturing plants that are going in as well. So the industrial growth is geographically dispersed, but the short answer is yes, it's concentrated up in the north.
Okay. And Rick, sticking with you, so a question on the 5.5 BCF a day in exports. What are the implications of that for Mexico's gas processing facilities? Will those be retired?
I don't know that they'll fully be retired, but we should probably reasonably expect some of the utilization rates of those to decline, not just because of the increase in imports, but also because the expected decline in domestic production. Of course, that's assuming that you believe that domestic production will decline. The scenario forecast projects just the opposite. So but yes, over time, I would expect utilization rates to decline. As to whether or not any of those facilities specifically get retired, I don't have an opinion on that directly, but lower utilization rates should be expected.
Okay. So there's another question, which is I can handle. That was when we quoted the day-ahead prices. Were those daily peak or were those averages across all hours? Those were averages across all hours. And then we've got another question on basically reconciling the renewable target between the numbers that Rick quoted and the numbers that Sam quoted. And maybe Sam, if you can handle that.
Yeah, I think the confusion is there just because it's expressing the figures that I had versus the ones that Rick had on one of his slides. They were just expressing slightly different things. Rick's chart had the total installed capacity of renewables in the country, whereas the target that Senair is setting is actual production to come from renewables. So by 2025, they want 35% of all power production in the country to come from renewables, not just 35% of installed capacity to be renewable. So that's why it's such an aggressive target. I mean, you need the turbines and you need the panels, but you also need them producing.
Yeah, and just to add on to that really quick, that's Sam's right. That's the difference between installed capacity versus utilization. So like on the gas side, it doesn't appear that the majority of currently installed generation capacity comes from gas, but the reality is that the majority of generation does come from gas, even though gas capacity does not make the majority of installed volumes.
Yeah. So I think we'll do one last question, just looking at the time. Is Genscape planning to develop real-time and day-ahead forecasting when that market develops? So for those of you who are clients of ours in the U.S. markets, we offer what we call Power IQ, which is very short-term focused and is a full nodal model that does congestion analysis and hourly price forecasts. We are in the process of developing that for the Mexico market. We have the full network model. We've got historical demand. We've got the full supply stack. So we are planning to roll that out by Q4 of this year. The gating item is simply that Senase is not yet publishing sufficient data in order for us to run those models. So we need data such as the scheduled transmission outages to plug into our models. And so you can think of, really, we'll have the EPSI model for the long-term forecasting, and then we'll have Power IQ, just as we do in the U.S., for the short-term BAL-day, next day, day-ahead, and real-time forecasting. So with that, I want to thank everyone for joining the call. If you do have further questions, again, please feel free to contact either of the speakers or your Genscape sales director. And contact information and the slides will be sent to you by tomorrow.